Hello, welcome to lecture 4 of module 4. In the previous lecture of module 4, we deliberated on different profitability ratios based on sales as well as profitability ratios based on investment. Over and above, those profitability ratios which are more or less hovering around the information which are imbibed in financial statements. But at the same time, the analysts, the investors or the so-called external users are more inclined to know about the profit making ability vis-a-vis the market parameters or the market matrices. So, it is imperative on the part of the technique which facilitates the profitability and its manifestation by establishing relationship between different financial variables which are disclosed in the financial statement with that of the market dynamics which is getting reflected in the market price per share of a particular company. We all know that the market price at which the shares of a company gets traded in the stock market is a mirror image of what is happening in the business organization. But at the same time, because of market anomalies which are prevailing extensively in the stock market or in the financial ecosystem, it is necessary to dig out whether the market price is undervalued, overvalued, or the market price is fairly balanced, which is in consonance with the book value per share. So, in this pursuit, it is essential on the part of the investors who are intending to commit their capital in the form of shares in a particular company, they are more inclined to dig out those aspects which are related to the market dynamics of a particular company. So, that can be addressed by calculating different market based valuation ratios which you are going to delve in this lecture. So far as the concept of market valuation ratios are concerned, as I said just before, the investors are inclined to know whether the price what is offered in the market so far as a particular share is concerned, is it legitimate or not. So it is imperative on the part of the investors to know by considering different financial variables which are there in the financial statements and to establish a relationship so that they can deduce a better picture with regard to the profitability of the company vis-a-vis the market dynamics. So, there are different ratios which are calculated related to this domain, but before getting into those different ratios, it is essential to deliberate on the significant contributions of market based valuation ratios which are part and parcel of profitability ratio and duly encompasses the dynamics of profitability in relation to the market orientations. Now, to start with, when you are going to talk about significance of market based valuation ratios, the first significance is formulation of investment strategy. Just before, I am talking about the investment strategy. Just now I mentioned that it is the potential investors who are more inclined to know what is happening in the business in terms of profit and at what price the same share is offered in the market for investment. So, when they are into the protocol of devising their investment strategy, they are essentially interested to lucidly dig out whether the price is fair or over or under with regard to the book value associated there with that of the shares. So, it is essential on the part of the investors community to deliberate on the ratio which is going to facilitate them to dig out whether it is in par or it is overvalued or it is undervalued. Then there comes the next significance is portfolio management. We all know those who are frequent traders, those who are regularly playing and executing their orders in the market being an investor, they are required to revise their portfolio conditional upon the movement in the market pervasive forces or the macroeconomic variables which are going to have a bearing on the market price per share. Now, we all know that share prices are absolutely dynamic in nature. They are going to change with every fraction of second conditional upon the dissemination of market sensitive information with regard to that particular company and how fast and frequently it is getting disseminated in the price. So, when we are talking about portfolio, every investor carries a portfolio just to spread the magnitude of risk associated with the total quantum of investment. So, they are frequently into the process of revising their portfolios so that they will optimize their return irrespective of different vulnerable conditions, and the market based valuation ratios are handy enough to contribute at the end of the investing community to do so. Moving further, it provides a perspective for valuation of shares, because when you are going to talk about the share and its valuation, we all know that the market is valuing the shares differently and the financial statement connotes a different value so far as equity shares are concerned. So, now when you are going to talk about the investing community or financial analysts or financial services providers in the market, they carry different perspectives. Now, market based valuation ratio accommodates different financial matrices which serves the varied interests and objectives of different users backed by different perspectives. Moving further, the market based valuation ratios also facilitates the projection of return and growth, because when you are going to talk about investing class, they are not solely dictated by the revenue return in the form of dividends, rather they are more inclined and biased towards getting the capital return after carrying the investment for a designated window period. Now, when you are going to talk about capital return, it can only be reaped after the span of a particular time. Now, during that span of time, what is the extent of growth? What is the magnitude of growth? It is all conditional upon the return which they are computing or they are apprehending with regard to a particular share in terms of their market price. So, the market based valuation ratios also contributes specifically to dig out the growth as well as the return perspective. Moving further, it also facilitates unfolding market sentiments, because when you are going to establish a causal relationship between the market sentiment, essentially the market sentiments are getting transmitted into market prices. We all know when you are going to comment that there is bullish market, when you are going to comment the market is under the grip of recession. So, these are nothing but the statements which are triggered towards the market sentiment, and whatever may be the market sentiment, it is going to have a significant bearing on the market price of equity shares at which they are continuously going to be traded. So, different market based valuation ratios are also tapping into that particular aspect and facilitate to unfold and appraise what is happening to the market price of a share if the market sentiment gets reversed. Moving further, the last one, there are many, but I am going to conclude the significance of market based valuation ratios by discussing the last, that is comparative analysis. There is one point which I just discussed under significance, that is portfolio management. When the investors are choosing shares from out of the available lots based on their profit making ability vis-a-vis the market price per share, they are always into a state of comparison so far as their decision is concerned, because without having a proper comparison, they cannot arrive at an informed decision with regard to which shares they are to carry, which shares they are to square off in the market so far as their revision of portfolio is concerned. So, it is essential and imperative on the part of the investors to facilitate a comparative analysis so that they can end up with an efficient portfolio which can optimize their return over a span of time. Now, after having deliberated on this significance, let us move into different market based valuation ratios. The first is dividend yield ratio. Essentially, dividend yield ratio is going to establish a relationship between dividend per share and the market price per share. When you are going to talk about dividend yield, it simply reflects that if an investor is going to buy a particular share from the stock market, how much he is there to contribute and commit. Now, on the other hand, how much dividend, which is otherwise a proxy of the revenue return associated with a particular equity share, how much revenue return is expected from that particular share from the company. Now, by establishing a relationship, we can easily ascertain what is the yield, because say for example, if the market price per share is 20 and the dividend per share is say 2. Now the question remains whether the company is paying sufficient dividend enough to the equity shareholders who are committing 20 rupees per share with the expectation or with the anticipation that they are going to end up with rupees 2 revenue return. Is it sufficient enough? Then again it is a very subjective orientation, because those who are speculators, those who are aggressive traders in the market, they are not bothered about the dividend return. But at the same time, those who expect a regular return at the end of every year in the form of dividend, they are very sensitive towards this particular ratio, because how much they are paying against a particular share and how much they are ending up with in the form of dividend at the end of the year, that is highly sensitive so far as investors who are expecting a regular return at the end of a financial year. Moving further, the next in the pipeline is dividend payout ratio. It is one of the most celebrated ratio which is used invariably by different class of investors, irrespective of the fact whether they are retail investors, whether they are institutional investors, whether they are foreign institutional investors or domestic institutional investors, whoever they may be, whatever class they belong to, they are making use of this particular ratio extensively in order to know about the states of affairs in terms of profit vis-a-vis the market. Here we are going to establish a relationship between the dividend per equity share and earnings per share. Now, when you are going to talk about dividend payout ratio, in one hand we are taking the earnings per share, which simply talks about how much net revenue is made available to equity shareholders so far as the earning of the company is concerned. On the second orientation, we are taking into consideration the dividend per share. Now, this reflects the policy at the end of the company, whether the company is going to utilize major chunk of their earnings for distribution in the form of dividend, or the company is going to retain major chunk of its earning for reinvestment purpose and curtailing the payment of dividend to the equity shareholders. Now, this is a very sensitive issue, because there are investors who are expecting dividend return, they are not going to be happy, they are going to take it very negatively when this particular ratio is low. Because if a company, say for example, is earning 100 rupees per share and the company is only paying 20 rupees in the form of dividend to the equity shareholders. Now the question remains, only 1/5 of the equity shareholders, only 1/5 of the earning which is generated by the company goes to the equity shareholders. 4/5 of the earning is getting reinvested in the business. Now, that reveals a lot of, you can say, antithesis, because there are at times which are experienced in the corporate world that there are some managers who are backed by their vested objective. They may invest those 4/5 of the earning retained in the business in those projects which is not going to reap sufficient return, which are not that lucrative as an avenue for investment. But at times it was witnessed in the corporate world that they are into this set of practices which is not going to be taken off so positively by the investing class. Moving further, the price earning ratio. Again, this is one of the celebrated ratio among the investing class because they are paying absolute significance to this particular ratio because this establishes a relationship between market price per share and earning per share. And here we are establishing a causal relationship between the price at which an investor is going to purchase the share vis-a-vis what is the earning the company is generating per share. Now, this share, why is it sensitive? Because essentially it talks about the value of the investment. If I am paying as an investor, if I am paying 100 rupees against a particular share by buying it from the market and the company is earning say 20 rupees. So, it may come to my mind, I may apprehend, I may assert into a state whether I may say that the market price reflects an element of overvaluation. And we all know in the share market or in the stock market there are many other forces apart from the company fundamentals which are having a bearing on the movement of share prices in the market. So, it may so happen because of the prevalence of heavy element of volatility or fluctuations, because of the prevalence of artificial exaggeration in terms of prices through creating buying pressures in the market, by creating market anomalies, it may so happen that the price at which the particular share is getting traded in the market is over compared to the earning available. So, there can be many different orientations with regard to this particular ratio. Now, at times when we are talking about the investing class, it is their imperative, it is their perspective how they are going to take it up. But one thing is for sure that price earning ratio is very sensitive because price earning ratio is one of the most extensively used valuation metrics. It assesses how much investors are willing to pay for each unit of a company's earning. It exhibits a relationship between market price per share and earnings per share. A high PE ratio recommends that the market has high expectations for a company's future growth and is willing to pay a premium for its stock. Now, if this ratio is very high, obviously it is concluded that the market or the aggregate class of investors are absolutely positive towards the future of the company. So, that is why it is very sensitive so far as taking or executing different investment decisions in the market. Then moving further, it is earning yield ratio. Now, when you are going to talk about earning yield ratio, it establishes a relationship between earning per share and market price per equity share. It is just the reciprocal of price earning ratio. Now, why are you going for reciprocal? In what way it contributes towards the task of taking different investment decisions at the end of the investing class or those equity analysts or financial services providers who are rendering or offering suggestions and advices so far as the future investments are concerned. Now, it establishes a relationship between earning per share and market price per share, and one of the most critical ratio applied by potential investors to arrive at investment decisions. The earning yield ratio compares a company's earning to its market price. How much a company is earning and at what price it is getting traded in the market. Whether a particular investor by buying that particular share is worth so far as the earning potential of a company is concerned. Now, that is a very sensitive question which need to be unfolded, because without unfolding that it is very difficult to comment or to purport the fact that whatever I am investing, it is legitimate and robust. So, it is imperative on the part of the investors to know the earning yield ratio. Moving further, it is market to book value ratio. We all know that when you are going to talk about market price per equity share, it is influenced by a bunch of variables related to the market pervasive forces, so called the external forces, which are hovering around and having a bearing on the market price per share. At the same time, there are also certain fundamental financial variables which are also posing an influence on the market price. Now, by calculating this particular ratio, essentially we are establishing a relationship between how the market reads the company and at the same time what the company's fundamental talks about. So, there is always a trade-off between these two orientations, because as for the fundamentals of the company in terms of finance, what is going to be the value of one equity share? On the other hand, from the perspective of market, what is going to be the value per share? So, here when you are going to talk about market value to book value ratio, we are taking market value per equity share and book value per equity share and their relationship. Obviously, when you are going to go for the calculation of book value per share, we are taking into consideration the book value which is shown in the balance sheet in the form of share capital, then we are adding the reserves and surpluses, we are adding all the accumulated profits, then we are subtracting all those accumulated losses, and by making all sorts of calculations, we are calculating the total amount available for equity shareholders. Then we are dividing the same by the number of equity shares in order to arrive at the book value. Many a times it happens that book value per share is lower than the market price per share. If it is so, there can be different assertions, there can be different orientations to interpret it. One investor may interpret that the book value is less compared to the market price owing to the simple reason that the speculative activities are heavily there in the market and the speculative forces are driving the market price per share upward, and as a consequence to that there prevails the gap. But on the other hand, it may so happen that the another class of investor may read it otherwise. So, when we are going to have a relationship between market price per equity share and book value per equity share, we can be having distorted conclusions. It depends the perspective, the intellect as well as the experience of the investor in the context of reading these financial matrices. But one thing is for sure, this is the ratio which ultimately contributes towards the decision whether the particular share is overpriced or underpriced or fairly priced. We say that the share is overpriced when we see that the book value is low and the market price per share is high. When it is otherwise, the market price is less but the book value is high, we are ending up with a conclusion that there is understatement of price, so it is undervalued. Rarely in the market we come across a situation or condition where the equity shares are fairly priced, because it is very difficult to ensure a fair price orientation owing to the prevalence of aggressive investing activities by the speculative players, because they are backed by the very objective to distort and dilute the market, create artificial volatility in the market so that they can capitalize on those artificial volatilities by dragging the prices either into a state of overvaluation or into a state of undervaluation. And we all know that whatever may be the market, whatever may be the country, it is always the speculative community which is driving and dictating the market in terms of market movements are concerned. So, it is essential on the part of the investing class to dig out whether the price is fair or undervalued or overvalued. Now, there comes the limitations of market based valuation ratios. Here we talked about different sensitive market based valuation ratios, and they are unanimously contributing and facilitating towards investment decision making at the end of the users community. There is no dispute, but at the same time these market based valuation ratios are having impediments, they are having loopholes, they are not free from errors. There is every possibility of impairment of those ratios which are calculated by having a blend of relationship, whether it is price earning ratio, whether it is earning per share, whether it is dividend yield ratio, whether it is dividend payout ratio, whether it is earning yield ratio, market value to book value, whatever may be the ratio, there is the prevalence of impediments which need to be taken care of while applying these things for the purpose of investment decision making. To start with, there is the market sentiment. Whenever you are going to establish a relationship between market price per share in one hand and one of the financial variable which is picked off from the financial statement outrightly, or which is calculated using different financial items which are disclosed in the financial statement. Technically, if we see to it, we are comparing two things which are not identical, which are not at the same platform. Because when you are going to talk about market price per share, it is completely dictated and driven by the market sentiment. There are prevalences in the market that the company is soaring very high in terms of profit, the company is having very strong credit worthiness, the company is having absolute financial affluence, but at the same time the market price per share of that company is declining, is under a recessionary state. So these are the anomalies which are there witnessed in the market because of the prevalence of market sentiment and the dominance of those forces which are taking the price away from its fundamentals. So whenever we are using market based valuation ratios, we cannot close our eyes towards the market sentiments, because completely relying on the market based valuation ratios may lead to very unfavorable decisions so far as investment is concerned. So it is always advisable on the part of the general class of users that do pay heed to the market sentiments, because they are capable of diverging those financial ratios when they are used and applied for the purpose of investment decision making. Then the next is industry and sector variations. We all know that the market is falling under the purview of industry. We all know that there are different sectors which are differently influenced by the same condition in the economy or in the business ecosystem. It may so happen that at a particular condition, IT industry is getting favorable consequences, but cement industry is getting unfavorable consequences. But the condition would remain the same. Now, when you are going to make use of market based valuation ratios and you are not considering the industry and sector variations, then it may so happen that you may end up with one subdued investment decision, which is going to undermine the return which you are expecting out of the act of investment. Moving further, all these ratios, market based valuation ratios, are more or less carrying a short term horizon. It is reflecting the short term fluctuations. But if I am a class of investor, I belong to a service class and I do not want to actively follow the market, rather I am backed by the very attitude that let us commit some capital in the form of investment in equity market and keep mum, keep silent. So essentially I am backed by the attitude of carrying my investment for a longer horizon. But all these ratios are more or less short-sighted. They are carrying the near future. They are not going to talk about the far future, owing to the simple reason that the market is so dynamic and vulnerable that it is very difficult to predict or foresee the long or far future movement in the prices of equity shares. So nobody does that. But at the same time, there is a class of investor who would like to investment for a longer span of time. For them, it is of very difficult condition to make use of such ratios. Now, with this, when we talk about market based valuation ratios, obviously there are favorable consequences, but at the same time they are not free from challenges, they are not free from threats, because we are considering two different worlds. One world which is talking about the bookish orientation, the other world which is talking about the market which is absolutely dynamic, vulnerable and going to behave in any way, may it be realistic or may it be a hype. With this, I make an end to this particular lecture by saying that irrespective of all these facts, market based valuation ratios are extensively and significantly used for the purpose of rational investment decisions by different class of investors. Thank you for your patience.